Good morning, everybody. This is Dennis Warren with the Active Trend Traders. I want to welcome everybody to the How to Make Money Trading Stocks webinar. We're really pleased today that Michael Bischoff is joining us from Zurich. Are you there, Mike? Michael.
I'm there.
Okay.
Hello.
Oh, I'm really excited. Michael's going to be bringing a little bit of the some global flavor into the Active Trend Traders overview. And as we run through the slides, he's got some slides for you to think about. He's been working in the, oh gosh, for about 20 years you've been working in the financial markets. Is that correct, Mike?
Yeah, more or less.
Okay.
Starting as a risk manager and now advising clients.
All right. So let's get going. I want to remind everybody that the Active Trend Traders, what we do here is for training purposes only, and traders should always paper trade any new method prior to the risk of their own personal capital. I really believe in training, and I believe in trying to help people learn to, better manage their funds and take more control of their financial futures. And we do a Wednesday night training session that is recorded if you can't join live. And this past week we did a good session on how to simplify your analysis of both stocks and ETFs. This week I want to be chatting about basically how to form and find pinpoint entries. Just a little refining on how to make things happen going forward. And so some of the other up and coming pre-market observations, we're going to be talking about that, market update emails. These things are already in place. And we've been providing these, especially with this soft market that we've been having. I'm trying to get that early morning pre-market update, out to folks to say, hey, here's what I'm doing, here's where I'm going, or if I'm just sitting and waiting. I was rereading a little bit of Jesse Livermore's biography this past week, and I was amazed. He said that the majority of his money was made not by being so active in the market, but by just sitting and waiting. This week in the market, we have seen basically high volatility and big swings. It seemed like almost every day brought a new direction to the market, and we can say the same thing about today. And as Mike Traeger, who's from Dallas, who's not going to be joining us today, but Mike was saying that, from a historic standpoint, these big, large swinging days is very, very typical of the character or the personality of a market that may be going into a more significant decline, more significant downtrend than we've seen so far. So on each of the indices, it appears my tracking indices, it appears that prices are moving down towards retesting their recent swing low, and then we'll see if we get a bounce there. If that floor holds, we may get a short-term trade to the upside, but for the interim, we're close enough to just wait, hold on until we get there to see what in fact takes place. S&P headed down for retest of the low, probably. NASDAQ, the trend is down, but it's holding up a little bit better than the other two indices, and the Russell is closest to retesting that floor. One of the things that we've been looking at, and you read the Wall Street Journal or any of the Yahoo Finance and some of the other things, that there's this just major concern. A lot of print is coming out right now about the concerns of global growth. And in the U.S., the fear that the contagion it's been contagious and reaching the U.S. market. But a lot of it is in the U.S. market is due to our own fault because of government interference. And then on the 17th of September, the Fed comes out with their new announcement on whether or not they're going to increase interest rates. And so I'm anticipating a lot more market volatility between now and the 17th of September. And the other thing I'm keeping my eye out for is acceleration to the downside. I always like to pay attention to the stocks above their 20-day moving average on the NYSE. And this is where we were last week. And then here's where we are this week. We came up, and as Mike Traeger and I were talking about on Wednesday, what we're seeing is a holding off here, staying below the 30, which is typically a trigger to go to the long side, but staying below the 30% level. And it did get as low as almost close down to 5% about 2 weeks ago. That was the Monday, the big Monday crunch day, which took us down, took out the lows from October. And so we could say, hey, you know, momentum is building for a potential upside move, but that's not necessarily true. During the market corrections in the past, this particular indicator tends to run, you know, it'll run back up here to 65 and then drop and hang out down here below the 30 level. So it's a slight revision and shift of what provides us our actual triggers, and that's what we're looking for. And let's see, one quick other thing is this is the same chart, but this is a weekly chart going back to 2011. And this is not the 20-day moving average, but the percentage of stocks above their 200-day moving average on the NYSE. And as you can see, as of 9 o'clock this morning, it was seen at about 27.96. It's reaching lows that it hasn't seen now. It did reach that low back in October last year. And then prior to that, we were looking all the way back here in 2011 when this was that real quick correction in 2011, dropped about 15% on the indices, and then it rebounded. So let's see if we get back down here and test in these areas, which continues to show the overall weakness in the market. And what's Mike Traeger is always pointing out is this particular chart and also the percentage of stocks above their 20-day started showing a negative divergence in the stocks participating in the uptrends, because you got to remember that while this chart was making lower highs, the market itself was going this way. Perhaps I can draw that. I don't know if I can or not. And the market itself was making these higher highs. And so this was showing us that fewer and fewer of the stocks that were incorporated with this were, in fact, participating in the big moves. And so anyway, Michael, I don't know if you use this particular chart, but with regards to percentage of stocks. But Michael, over there in Switzerland, you primarily trade the U.S. market, correct?
Yeah, or at least it's the market to watch most closely. Yeah, so 70%, I'd say.
Okay. So, well, folks, I'm going to switch over to Michael. He's going to give us a presentation. He's going to provide some slides about what he sees going on. And I'll just, Michael, I will turn things over to you. I'm switching the mouse control over to you, so you now have it. Let's see if it functions. It is functioning.
Oh, great. Okay. Perfect. Well, I thought it might be a good idea just to focus on one topic every week, and in a quite well and a popular blog in Switzerland. Professor Geiger is the guy. He's quite a prominent former lecturer and also a line manager and a politician. And in his interview, he basically said that, and it was quite emotional, that in the past the markets behave rationally and now it's kind of a gambler's place. A second statement was that these manipulated interest rates, they confuse the world, and the financial world ran out of concept. And at the end, his recommendation was kind of not to panic, and that the solid traditional asset management with stocks, bonds, real estate still works the best, and focus on quality stocks, and don't try to do any short-term trades, and don't try to beat the market. And it was, to my surprise, a little bit as not perceived well, and there were some nasty comments, and so I thought, how about to grab this point and to try to give some facts to it, and just say from a investor perspective if his judgment is true or not. Just to start, where I really have my problems is to say that formerly the markets behave rationally, and now it's kind of a gambler's place. I mean, if we take PE ratio or whatever, I would say, then we had times where the market was more underpriced, definitely, and of course, especially in around the dot-com bubble, but also before the crash in 2008, 2009, we had higher valuations. Other ratio you could use is where did we have big drawdowns in the market, in the bond market as well as in the stock market. And actually you have to say, well, 2007, 8, 9, and about 2001, these were really big moves. But if you look back, we had bigger moves, and so from that point, I would also not say that the markets now are more irrational than former. And if we take daily moves, then certainly not. I mean, all the option traders in the last 2 years were complaining that volatility is so low, and they can't do any selling premium gets more and more difficult. So also from this point, I would not agree to this. I think we have here a lot of traders, investors. I think we have very liquid markets, I think, and that also high frequency trading is, I would rather say that that they help that the market finds his price quicker. And I mean, if we compare now to US market, the last very turbulent days, I think we only had one day, which was last Tuesday, where it was really kind of an untradeable market with big spreads. And if you compare it with an not that mature market like China, there, I mean, in the last 3 months, we had moves from 3, 5, 7% a day, and it was not a one-day event, but it repeatedly day by day. Then still, the mom and pop traders are not back. I mean, if you ask the taxi driver, or if the taxi driver asks you which stock to trade, he won't, because he's not back. And another interesting analysis I've read is this weekly global investor survey from Centix. I think most managers there, money managers there participating, come from Europe, but the signal was very clear in the last 2 weeks. The little rebounds they used to reduce the risk and not to jump into the market again. And also a lot of managers preferred to sell with a loss than to stay heavily invested. So I would definitely not agree that the rationality of the market has changed.
Hey, Michael, let me ask you a real quick question, if I may.
Sure, yeah.
Okay. Down here where you basically say that the global investor survey, as of last week, was showing that the money managers were reducing risk when the market was rebounding. What that sounds like to me is the market managers were liquidating positions on rebounds.
Yeah.
Okay.
Yeah.
Which that can be the precursor, or at least can sow the seeds for a larger correction than we've had so far. Do you agree?
Yeah.
Okay.
Yeah, I agree. Totally.
Okay.
And was interesting to see that the European markets did not correct that sharply in the last 2 weeks, but they already are really on 200. They are quite. I think they kind of bottomed out, where and look a little bit better technically than the US.
Okay.
But it's difficult to predict it, because I think they are the investors are very scared.
Yeah.
And so the US dictates the direction.
Yeah. Yes. Okay.
How can I go on?
Right down here.
Or can you do it for me?
I can.
Okay, yeah, good. Then another point is the whole topic of this extremely manipulated zero interest rates. I mean, that's no doubt, and I think it's worthless to discuss. I mean, that this cannot be sustainable, and that I think he's really right with the statement that they ran out of concept. And also interesting graphics I found from report is this correlation between stocks and treasuries. And what we have seen in the last days, weeks, but also I would say years, is that that stocks are rising and US treasuries are rising too, and the other way down. Stocks are going down and US treasuries are going down too. And so there you see that this typical mix, you have bonds and stocks, or that bonds are not a good diversification to stocks anymore.
Yeah, because
And in these manipulated markets, I think that's not really surprising.
yeah, because in the old days, 20, 15, 20 years ago, um, you would a person would tend to want to, roll into bonds for the expected bounce in those as the market was going down. But it seems like now they're totally correlated.
Yeah.
Okay. So hey, one of our
And what I was really surprised is that gold was not really significantly rising in the last 2 weeks. I mean, historically, in days like this, it could easily have gone up 15, 20%.
Exactly. So one of our members online is basically says the manipulation of the interest rates and the unclear reports about things like employment in the U.S. and I'm sure and I'm I have to say I'm totally blind. Like I don't know if they report employment in Europe the way we do here in the U.S. But he said that the reports about unemployment and abnormally low oil makes the market look a lot healthier than it really is.
I think every government sector makes it look better than it really is.
Okay. So when you're ready to advance, all you got to do is just, can you see that?
Yeah, please do.
Okay. There you, okay, here we go.
Okay, and then, and that's, I think, really an important topic. We can maybe go on with the discussion in the weeks coming. If the solid traditional asset management, buy and hold strategy, stocks, global stocks, and treasury is really the holy grail. I mean, if you make this long historical analysis, then typically the result is yes, it's still the best strategy. But then also a fact is that in the last 15 years it did not really work. I found this from Schiller. The markets as measured in US dollar purchasing power, and there you see, I mean, stocks, the absolute stock chart looks fabulous, but in US dollar purchasing power, it's relatively flat.
Yeah.
Especially if you did not if your timing was not that good. And with bonds, it looks a little bit better, but I think there we are almost in bubble territory.
Okay.
And I mean, if you take the 60s, 70s, also the typical stock bonds portfolio did not work. And this chart is just the same as in the slide before, and it's also not that promising.
Yeah.
And so I think the better diversification is not the typical asset allocation, but to diversify in passive and active strategies, and more importantly, short term and long term. Because I mean, the story that we have that the world economy as such grows year by year, with some exceptions. Yeah, I wouldn't bet on this.
Yeah,
the last 15 years may be more the new standard, and not the big exception. I mean, I think there are also quite a lot of some plausibility for this. I mean, the whole stock market, the technology, and the available information has changed that much in the last 15 years. And also this disruptive business models, like I mean, even companies like Coca-Cola or IBM is a good example. I would not bet that this is really that they are so successful for the next 20 years. I mean, new Googles, new Apples are coming. That's for sure. And I think that there are really a lot of myths about passive investment, and so I would really recommend everybody to take a look also in short-term diversification.
You know, I really like this concept down here, Michael, on with the aspect of diversification being both a passive and an active approach, correct? Where the passive is more the long-term buy and hold type, you know, the old school way, if you will, and the active being a little bit more on the, you know, kind of like the active trend trader type system, right? Where we're a little bit, we're more actively managing our dollars, trying to get them to grow.
Yeah, definitely. That's exactly the point. Yeah.
Are you ready for me to go on?
Just if you just go one back.
Okay.
Yeah. I mean, if guys like Jim Rogers are who always says he's a terrible market timer, advises everybody to learn how to short stocks, or I mean, most points. So I'm not a fan of Mark Faber, but I mean, he's saying he would be happy in the next 5 years, or his goal for the next 5 years is not to lose any money. and yeah, if he's right, then the only way to make at least some additional money is to profit in some short-term gains. Okay. Well, I think that's it for this week. So, and I'm happy to, if there are other statements on this. So I would the story in the past markets have been better or more rational, and now it's only a gambler's place. I would really disagree. The whole artificial interest rates and increasing debt levels, I think that's really dangerous. There I totally agree on the Prof statement. And with the solid traditional asset management, I would not completely disagree, but I would not bet on it, and that's exactly what all the big pension funds do right now.
That's right.
And they're just saying, well, the last 15 years our performance has not been that great, but historically better times should come, and there I would be pessimistic.
It's that old aspect. The pension fund's going to continue doing what they've always done. They'll keep continuing getting what they've always got, and for the last 15 years they have not done well, as you say. And wasn't it Einstein or who did say that if you keep doing the same, you know, the mark of craziness is if you keep doing the same thing expecting different results?
Could be, I don't know.
Okay.
At least it's a good statement.
And okay, excellent. So Michael, next week you're going to be talking about, is it time to change gear? So you're going to be telling us to get out of the U.S. market next week?
Yeah, trying to do.
Okay.
That's on the agenda. If there are some urgent movements, then yeah.
Okay, excellent. Hey, Michael, thank you very much. We'll proceed on and take a real quick look at the market. Guys on online, please shoot in some if you have questions regarding anything from a global perspective or from Michael's perspectives. Please shoot those questions in so that I can get those over to him. And that's awesome, because I think that having, why not have a flavor for not just the US perspective, but worldwide, because I think it's always interesting to see what people are thinking in other parts of the world. And so Michael, thanks for joining us today, and we look forward to next week.
Well, thanks for having me. Thank you. Bye.
Okay.
Oh, I keep online and
okay, yeah, just hang on.
Looking forward for the next topics, like always.
So here we go. We've got basically, as of 9 o'clock this morning, the Dow, of course, was down. We have the Dow is getting really back down close to that 10% correction territory, and I think it may have happened while we were online. S&P down from last week. The NASDAQ has now turned back to gone into the negative for the month, or correction, for the year. This is a year-to-date definition, and the Russell is down also. What's very interesting is, keep an eye on this. Okay, yes, the Russell is down from last week. However, it is down less. Now, there's a couple of reasons for that, and we'll take a look at that on the stock, on the charts right now. Let me pop over here. Okay, let's look at the S&P. The S&P, the daily charts are on the left, the weekly chart is on the right. As you can see, is the S&P, after this large significant sell-off, here was Friday of 2 weeks ago. We went Monday, Tuesday, Wednesday, Thursday, Friday. Here's where we finished up last Friday, and now we have basically returned. And so this turned out to be a lower high, more or less a traditional failure type pattern. We got a retest a little bit yesterday, then now we are dropping back down. Should bring in the lower, the swing low, should bring that into focus and also into range, perhaps over the next week or so. But as you can see, with these large daily ranges, that's a target that could be reached within just a couple of days, and that's where I would plan. That's where I'm looking for, somewhere in this support zone here, to see if we're going to get a reversal or a breakdown below it. The hammer from last week on a weekly chart is still in play. That means that this particular reversal signal is still valid, and it will remain valid until the low of the wick on last week's candle is broken through. And so, and Judy, I'll ask that question in just a second. So there's the S&P. One of the things that I've been doing here of late is I have been really paying a lot of attention to, I went to a training session with the Wyckoff people over in San Francisco a couple of weeks ago, and a lady presented a very interesting presentation and a study that tied the European market in, the open and close, especially the close aspect, and also the Asian market into, I won't say predicting, but at least giving a flavor of what the U.S. market is going to be doing here of late. And it's been very interesting to watch what happens at about 8:30 in the morning here in California when the European market closes. There's a little bit of a jiggle in the market here in the U.S. And so it's kind of interesting. So NASDAQ, as we highlighted on Wednesday night, all these moving averages are basically saying, I'm in a downtrend. They're pointing down. We came up and tested the 8-day and then reversed down today. If we were going to get into this trade, and for those active trend traders, we're going to be refreshing and sending out some refinements on how we get into these kind of trades, and that's what we're going to be covering next week. yesterday was the day to trigger a trade for a potential downside run. And sure enough, we get this downside gap down, and then the sellers are still in charge so far. Got support down here at the bottom of this candle. And will the NASDAQ reach all the way down to this level? We'll see. But from a downside perspective, if it is going to go down and retest, the put options in October for the QQQs look very interesting, but they need to be timed properly. And so, Michael, are you still there with me? Okay. Michael, we got a question from Judy. Judy says, does Michael think the European investors are fleeing Europe and investing in U.S. markets, or are they, or have they given up completely with the stock market?
I would say neither.
Okay, you need to come a little closer to the mic. Can you come a little bit closer to your mic? There we go.
Sorry, yeah, sorry. Now I think it's okay. Huh? So I would definitely say they will not hunt US stocks now. I mean, all these analysts were predicting that this year will be a very good year for European stocks because just Draghi, this Draghi effect. He's the president of the European Bank and Central Bank, and they are now extremely aggressively, really aggressively buying European bonds. And I think that the timing was really bad because as soon as this was announced, and especially the German market was really rapidly going up, we had all these Greece problems, then China, and now US, and now it's difficult to say. As I think now they are, either they go into cash and wait for a while, or if they go in stocks, then they will invest in Europe.
Okay, that's good to know. Yeah, because I think
I mean, Switzerland is a special case. I mean, there the people have now in this year been wiped out twice. I mean, one, the unpacking of the Swiss franc, and now the overall market crash.
And so, yeah, it's Judy. I think while earlier in the year there was a quote unquote, part of what was propping up the U.S. market was in fact global investors were putting their money into the U.S. market. But I'm not seeing that happen right now. And so I think that's one of the things that is causing us to come a little bit unhinged and perhaps drop a little bit more. Let's take a look at the Russell. The Russell on a weekly basis had a really nice big bullish candle last week. However, it has now hit the top of that, turned out to be great resistance, as we can see here, and it is dropping back down. The amount that it has to drop before it retests the swing lows is a lot less. This is only approximately from current positions down to this level of the low is only about 2.8%, while on the NASDAQ and the S&P, you're looking at a 3 to 4 to 5% drop, and so that's why I'm favoring things like the QQQs or the SPY to trade to the downside. So that's what we've got going on with the markets right now. Again, this downtrend here. Let's switch over. I'll switch over just really quickly to the. Well, maybe I will. To the, there we go. Let me see if I can find, Okay, here was last month with the Russell. As you can see, it continued to break down hard. It has found a level of support that was long-term going back to 2013. But if that zone of support is busted, then we're probably going to revisit the 1040 level. And it's always a good idea, I believe, to take, when we're getting a big correction like that, figure out from the highs where a let's say a 15%, well, a 20% retracement would be, which that would put a 20% retracement would be approximately there, about the 1044 level. What happens if it drops all the way back down and from regular technical analysis and test the highs back in 2011? Well, we're looking for the Russell. That'll be a 33% retracement down to that level, which would put us down at 866. And that's where knowing where those levels of support and resistance of support is very critical. So let's move on very rapidly. There we go. So actually turned out to be we had a very good week this past week. Primarily by not trading. We had only the strategy 3 trade on, which is pulling in premium off of the for IWM off of the leaps that we own. And last week we were sitting here for up for the year 2,800. We've added about 2,100 this week. Bring us up to close to 5,000, as you can see. With the markets down almost 10%, I'm happy we're heading in the right direction. Remember with the active trend trading system that our motto is to both clarify, simplify, so that we can all multiply. We follow 5 pillars: what to trade, IBD growth stocks and index ETFs, when to trade, when to enter, when to exit, what strategy to use, and what to expect. This is in place now. The trend trading system then is the foundation for either stocks, index ETFs, and basic options, and or wealth building. Here's an example of what I'm doing. This is in my own account, and I'm doing this primarily as a show. Is I bought one contract of the January 16th IWM 123 calls back on April 30th. And then each week I've been selling premiums against that. Some weeks wound up in a loss, but with some of the refinements that were highlighted in the report I sent out to everybody, I think we're going to see this go more in the right direction. And so far, year to date, we've been adding about 3.6%. That's what we've been making on the original investment of $760. And you go, well, that's not very much, only $27 a week. But the thing about it is I'm only doing one contract. So that's 3.64, $114 per month. And and there's what's real, we've almost got the underlying paid for, and we've got 19 more weeks of it till expiration to continue selling premium against this. And so here currently is the current return. And so I'm like I said, I'm quite pleased with how that is going so far. And so for this week, basically we did no trades for the strategy 1 or strategy 2. We're standing by waiting, keeping our powder dry in the downtrend. I will be introducing this week some refinements for being able to time this better, and we'll be covering that on Wednesday night. Strategy number 3, wealth and income. We gained $408. This is $408 worth of profit, so we took off the table, and we have a new call leg in effect. And for the early warnings alerts, we have a trigger, but we're waiting for the entry. And I want to thank Don for just dropping a note on how he's doing with the strategy number 3, and I'm very pleased with that. So for anybody who has joined us today, like I said, I don't really talk a lot about becoming a member and all that kind of stuff, but I try to treat each member like you're a member of my family. That's why I don't talk about, well, you're members. And if you're joining us today to watch the video, or if you watch it on the YouTube channel, you can go to this link and it will give you a special offer for a membership. So that's all I have for this week. We'll take a look at some stocks. I want to encourage everybody, keep the egg growing. Remember that Monday in the U.S. is a holiday. It is Labor Day. And continue to trade wisely, trade profitably. And if, in case you're wondering where we're at in the market, this cartoon still applies. So Michael, thank you so much for joining us today from Zurich.
You're welcome.
And go ahead. And I really look forward to seeing let's continue to exchange emails and chat next week about how we can flesh this out to give the How to Make Money Trading Stocks webinar a total, a complete global presence and global flavor moving forward. So thank you, my friend.
Welcome.
Okay. So,
thank you.
Okay, Michael, thank you. And I'm going to review some stocks with folks. You can either hang on or jump out, whichever you prefer. So, okay, anybody want some need some? What stocks can we look at, guys? Okay, Tracy. Tracy, how you doing today? Alive, okay. Let's see, got the daily and the weekly going here. Let's take a look at Tesla. Tesla's a stock that I am, like I have mentioned several times in the after hours update, market update, that I'm very interested in buying Tesla eventually. Okay, and right now I'm waiting for a potential setup. I like doing either one of two things: owning the stock itself, not a lot of it, it may be 50 shares, it may be 100 shares. The other thing I like about it is jumping onto it with a January 2017 leap, being either at the money or slightly out of the money. The projection on Tesla is that it's going to move up to, within the next couple of years, move up to about $465 per share. And so if it's sitting right now at $238, $240, that's a significant move. And so if I'm owning the 240, 250 leap, call leap, in 2017, I could participate in a lot of that move. And so I'd be looking at owning either one or two contracts. I'm not going to go big in it. And then during the week, I will then each week I'll do it just like I'm doing the IWM trade, but it's going to be longer term. I'll sell premium against it. This past week in my account, that my IRA account, I'm doing this consistently. I've got we picked up about $1,500, and I only own one contract in this with the action of Tesla this week. So Tesla, what I'm seeing is, okay, Tesla's going to come down. Here's the 100-day moving average. We may test there. It may drop on down and come down here to the bottom of the moving average channel and bounce from there. Or it may come down all the way down here, and that would be a really great opening for a potential stock. But I'll be looking for a potential turnaround, and we haven't got it yet, Tracy, just for FYI. And so I'm waiting for the reversal or the strong support so I can plan the trade from there. HAWK. Blackhawk Networks. Blackhawk Networks this is a perfect example of a stock that is in a downtrend, and any revisiting back up to the 8-day moving average, or in this case we visited the 100-day moving average on Thursday, and it reversed lower and it's dropping down. It will probably find support down here at the 37, 38 level, and potentially could bounce back up to 40, and we may get a ricochet effect in between 38 and 40, or perhaps all the way up to 41-ish. Or we could blow on through this and move all the way back down to its previous breakout and support level down here at 33.28. But I would say right now, if you weren't shorting it yesterday, you're probably going to want to hang out because it's kind of like moved into no man's land. Tracy asked on Tesla if I did that well on one contract, why not buy more? Well, Tracy, those contracts are about, I think I got into those contracts at about $50 a share, and I don't want to, basically have $10, $15, $20,000 tied up in with those contracts. So I want to have, be able to fish other places also. If there's a recording where you show how you implement the leap option, yes, Judy, for premium members there is. I don't know if I put it on the YouTube channel or not, but if I can find, I can find it. But I know for premium active trend trading folks, there was a training session that talks about that, and it's on the website under recordings. And I think you go down to either the 4th or 5th recording, and it'll take you right there. Let's see what else we got. RXDX. Okay, I am totally unfamiliar with this company, but it's, we got a, okay, whose is this? Gregory, what does this company, what is this company? What does it do? Okay, pharma, okay. So what do we get? We must have had something approved by the government or something here to get this big spike up, or they had good results. Let me pop up the, edit the stories, pull back in the volume. I want to see what kind of volume profile it has on a daily basis. Okay. Yeah, very lightly traded. So I'd need to do the stock checkup on it through IBD. Oncology, okay. IBD to see what kind of, what kind of a fundamental profile it had. But it is put in, some nice, pretty nice patterns. It's for a, $14 stock having an average move of, $1 per day. That's pretty significant, and it goes along with the market, with the volatility that's been going on in the market. It may be scooping out here to head higher, back up and retest back up in the $18 level. But if you were trading this, I would be looking for a pullback back around the 8-day moving average, which is the purple line, 20-day, or the 50. Those are, you've got a nice little clump of moving averages that look as if they are turning to head in this direction. That's what the moving averages are telling us. Does it have to happen that way? Of course not, but that's what it's telling us initially. Actually holding up pretty good considering the market. This right here would be a bullish engulfing, Tracy, right here at the bottom, where you come a nice little drop down. It totally engulfs that day, and away it goes. This would not be a bullish engulfing because it is at the top of an uptrend, and bullish engulfing from a reversal signal perspective, there only happens at the end of a downtrend. Taser. How is Taser doing lately? Okay, Taser is, yeah, it's actually looking pretty interesting from the aspect. Let me get rid of the, we were looking at Taser earlier in the year, remove all drawings, there we go. And so basically it spiked down hard with the rest of the market correction. It's moved back up into a level of resistance at the 24 level. What I would be anticipating and looking for this is it is in a downtrend. And so it is at a place where you could be looking at potentially going short. It has not reversed the downtrend. You've got, yes, the 20-day has started to level out, but right now this looks more like it is a moving average squeeze, where the 8-day can squeeze up here against the 20 and then roll over. Volume has not been above average, as you can see here, and so it's like I say, it's holding up well considering the market's down as much as it is today. But it is in that downtrend. And one of the things we covered on Wednesday night was, you know, if we want higher probability trades, trade in the direction of the trend. And clearly, this is a downtrend. It has gone into a downtrend, and it may very well retrace back up to, you know, one of the previous moving averages and then roll over, which it may be in a process of doing now. But it's certainly, you know, it hasn't given us a signal back to the downside, but it is not a strong looking stock. So what is the name of the RXDX? Juanita, I couldn't pronounce it. No, here we go. Ignada? That's why I always trade by ticker symbols rather than trying to repeat the name of the stock. So, okay, any other? Those of you looking for a potential good downtrend trade, looking for next week, remember to keep a look at your past winners like AMBA. AMBA today is looking like it's finding some support down, past support down here at 70. It may rebound back up, but as you can see yesterday with the failure of this hammer here, it really took a dive. And the stock that AMBA is taking with it is G-Pro. And with the weaknesses in both of these markets, why did not go up? There we go. And this is a sympathy trade, G-Pro. Where would I be looking for any type? Right now, it's not shortable. I would not be trading this to the short side simply because it's too far extended. It is a long way away from all of its moving averages. So we would be looking for a rebound, but we are at a past level of strong support. But as you can see, those big, huge volume days there, that is institutions going, I'm out of here, I'm gone. Would you play G-Pro's double top? Are you talking about here, Gregory? Oh, double bottom. That's a really great question. And I'll just draw this in and we can finish on this point today. Is okay, yes, clearly it is coming down, hitting against the previous low. One could take a speculative trade from bouncing here to move back up because that's could be expected that that's what it's going to do. However, that isn't necessarily your highest probability trade. We're trying to focus on if it bounces here and moves back up, then comes back, and it could even retest down below it a little bit, and then takes off from there. If on our indicators, we get this back up here, and it comes back down around the same place, but we get a nice little positive divergence going there, and same thing on the momentum. Let's see, it pops up a little bit and it goes back down, but it doesn't go quite as low, and you get a positive. That is the patient, and the tends to be a higher probability trade, because here we're getting rid of all the sellers. This gets rid of all the rest of the weak hands, and then pop, there it goes. The only question is this period right in here, we sit there, how much time will it take? So, okay, folks, that's it for today. Michael, thank you for joining us. This recording will be available probably within the next hour and a half to 2 hours. And please send in your questions or anything, comments, so I can pass them on to Michael. And I really appreciate what's going on, and appreciate your being here. So have a great week, Michael. Good day.
Thank you. Thanks.
See you guys. Thanks, Michael. I'll be shooting you an email.
Great.